Hi, everybody. Ryan Detrick here with LPL Financial Chief Market Strategist. Honored to be here for Reflections 2020, a year in review. I've only got 15 minutes here, so we're going to just kind of dive right in. For those who don't know me, again, been with LPL for about 5 years. Yes, I have my CMT. Yes, I look at market technicals. I think I saw John Murphy back in 2013 at a small little airport hotel over in Cincinnati, Ohio. It was awesome. I've been a member of StockCharts ever since and literally use it every single day. And again, a market technician, yes, but I'm a market strategist. So I use the F word sometimes when I'm presenting and talking. That is fundamentals. The joke that I use is the F word if I talk to other crowds is Fibonacci. So you can feel free and use that. But let's just kind of get into things. I mean, I like to look at the market based on kind of past history. And one of my favorite quotes, and I use it all the time, history doesn't repeat itself, but it often rhymes. So I'm going to kind of show what I think are some pretty interesting similarities to what we've seen in the past and what happened this year. And honestly, guys, what's probably going to happen again in the future. So there's just a big old picture of the S&P 500 using StockCharts data going back, to the late 1920s or so. Thinking about this year, for instance, this is going to be the first year in all likelihood the S&P was down more than 30% for the year at one point and finished higher. All right. Some of the only other times we've ever seen 20% drops from peak to trough and then finished higher were in 1987 and in 2009. Take a look at what stock markets did the previous years after those, what we'll call big flushes, big moves lower, but the stock market still finished higher. Something to think about. Also think about, again, we use the F word, fundamentals to a degree. This is an election year, and I do like looking at seasonality. I love looking at market sentiment as well when I come to my conclusions on where things are going to be. And in the back of my head, this time a year ago, well, we knew it's an election year. What a lot of people didn't point out the fact, though, that I thought was fascinating, if you go back to the 40s, since FDR, if you have a president up for re-election, stock market's never been lower. This goes back to World War II. Not about Republican, not about Democrat, about getting reelected, polling certain levers, certain things you got to do to get reelected. And, sure enough, it's an election year. Now, believe me, this is not like any year we've seen in a long time, and I'll talk about some of those things. But at the same time, market was higher once again. Also, we had significant gains last year in stocks. And when you have big gains, sure enough, the next year tends to be positive too. So all these different things were kind of swirling around. Then you had the fastest bear market ever, fastest 30% correction ever. And you think, well, there's no way that's going to come back. And sure enough, it has. But let's kind of dive into kind of some of the things that I'm looking at and following. So here again, I love looking at bigger picture things. yes, I'm sure a lot of people that are listening to this, given it's stock charts, are more shorter term by nature, traders, swing traders. But my new world is kind of from a bigger perspective with longer term investors. And I think it's really important to note this. Let's talk about this for a second. The idea of secular bull markets that can last for a long time. Now, you've seen these charts before, and I think it's just important to talk about it, though. My opinion is there is a secular bull market that started in 1950. As you can see there, the first shaded area. That's when we kind of broke out above those previous peaks that took place after the Great Depression. Stocks went up for about 18 years, all right, from 1950 to 1968. Then you had the secular bear market of the 70s. And then kicked off what many people call the 82 bull market. Now, I would disagree. I think it started in 1980. 1980 is when stocks made a new all-time high. And I know they pulled back into 82. I get it. But you made a new high. And then sure enough, about 20 years later or so, 2000, you had a major peak. Now, there's lots of arguments on when this bull market started. Most people say, well, March 2009. I think I disagree, and I know a lot of technicians would as well. To me, it was when we broke out in 2013. And by the way, if you followed me on Twitter and different places, I've been very bullish. I was very bullish. Made a name for myself, honestly, in 2013. I remember mid caps broke out, and mid caps and small caps were breaking out ahead of large caps back in 2013. And everyone said, oh, there's this big triple top, right? And you can see it there, 2000, 2007, 2013. But it's like, no, things are already breaking out. You're ignoring what's happening. You're ignoring the technical strength that we're seeing and just the negativity that we're seeing, which can be really powerful. And sure enough, markets kept going up, and I'd go on CNBC like every week and say, hey, you come on TV? I say, yeah, sure. They say, good, because we can't find a bear. I mean, people think this was some easy bull market. 13, 14, 15, 16, 17, 18, 19, obviously ending in 20. But it wasn't. There's a lot of negativity along the way. So my take again is when you see that breakout with people just really mad, really angry, like in 2013, so this could have a long way to go. And that's why I think that's another major bull market that started in 2013. And if you think about it, these other long-term bull markets that we had, they continue for a much longer than 6 or 7 years. Now, something I want to really point out now, though, the idea of 6 or 7 years. If you think about it, let's look at this now. There's something called the 7-year itch. And every 7 years, whether it be a relationship, whether it be a job, whether it be a car, there's studies and scientific data that suggest people kind of get tired of things, right? There's something happens around 7 years in that can make you uncomfortable. Now, look at the chart again here. In 1957, there was a bear market and a recession. 7 years after that 1950 to 1968 bull market took place. The bull market of 1980, as I call it, from 80 to 2000, 7 years in, you add 7, you get what? 1987 and a 34% correction. That was petrifying to people who were there at the time. I guess, I don't know, I was in second grade, so I guess I didn't really care too much at the time. But I've read a lot about the 87 crash, and obviously it was petrifying to go down that fast, that soon. Although the most recent bear market did go down, technically down 30% faster. So congrats on that. By the way, the March of 2000, if you look at the Dow, data goes back to 1896 on the Dow, is the most volatile month in the history of the stock market. The average daily change any day on absolute value was like 5% the month of March, okay, the 2020. We've never had a month that volatile. So congrats on getting through to the other side on that one. But if you add 7 years to 2013, when I think this new secular bull market took place, you get what? 2020. And now, of course, had no idea we're going to have a 34% correction and then bounce back to new highs just as fast. But again, Mark Twain said history doesn't repeat itself, but it often rhymes. 7 years into a bull market, we had a pretty significant pullback. Looks like, looking at my time here, I think I'm about halfway there. So doing good there, I think. I want to talk a little bit about pandemics, right? And if you think about it, every 50 years, we've had a terrible pandemic, all right? In 1918, obviously, the 100-year pandemic, terrible, right? Millions of people died. This devastation on the heels of World War I, by the way. And what happened to stocks, right? Stocks pulled back like 33 or 34%, okay? 50 years later, 1968, another terrible pandemic. Stocks pulled back mid 30% back then as well. You fast forward now, this is stuff we were talking about with our more than 17,000 LPL advisors and their clients. And again, no one truly knows, but I like to look at history for some type of a potential guide. I hope I don't butcher it. Churchill said, the further back in past we can look, the further into the future we can see. That's paraphrased. It was pretty close. And I think there's some truth to that. And sure enough, this time, terrible, horrible pandemic, global economy shuts down, global stock markets absolutely crash. Yet stocks pull back 34%. Ballpark where they pulled back every 50 years when we have a horrible, horrible pandemic. And, things bottom then. And just kind of fascinating when you think about that. At least I think it's pretty fascinating. So you have the pandemic there every 50 years. And, remember the story or the show Lawrence of Arabia? And there's that, I guess it's a candle, right? And the big guy comes up to the candle, takes 2 fingers and just clinches it and puts a candle out. And the other guy says, oh my goodness, like, wow, how'd he do that? So walks up to the candle himself or another candle, I should say, and tries to do it. And he screams in pain and yells. And he looks at the big guy. He goes, how'd you do that? Like, that's hot. How'd you do it? Guy replies with a very simple answer of, well, you have to know it's going to hurt. And, that's investing, right? I mean, yeah, believe me, if you were short in March, you probably loved it. But, for investors, you have to remember it's going to hurt. I mean, look at these long-term trend lines I'm showing you, or long-term gains. There are some pretty good sized pullbacks there. If this, what we're calling a new bull market that was just born with the new highs here, you know, recently, you think, okay, well, in 2010, 2011, what happened? Well, stocks went up for the most part, but there was a lot of volatility, and that could be kind of the play once again here, we think. So using some quantified data, though, at LPL Research, we were the camp we're not going to have a retest of the March lows. I'm telling you, everybody talked about a retest of the March lows. And we started looking at data like this, 20 days off the highs, or I'm sorry, off the lows. We had one of the greatest 20-day returns ever. And these charts I share all the time on Twitter. You can follow me at Ryan Detrick, and also our handle at LPL Research. Just using quantified data to tell a story. And you can see after the previous greatest 20-day rallies ever, stocks were higher every single time a year later. 3 months, 6 months later, they're higher pretty good amount of the time. And we saw other things like the percentage of stocks above the 200-day moving average. I know a lot of technicians use that, and just lots of different things that was in April. I mean, stocks gained over 10% in April. When you have a double-digit monthly return, guys, 3, 6, 12 months later, the returns are extremely strong. And we just had, by the way, in November, a double-digit return, which could bode very well for continued future gains. But you put all these things together, and we actually said we don't see a double dip. In fact, at LPL Research, we manage billions of dollars for our advisors. We upped our equity allocation on March 26th. We saw just true devastation happening out there. The Fed came out and threw the kitchen sink at things on March 23rd. And we said, there's so much negativity. Is the asteroid going to miss the Earth once again or not? And we said, well, we're going to bet on yes, it will. And sure enough, in a lot of the models we run for our advisors, we moved to some equities, in late March and then further in the spring and summer. And that really worked well. And a lot of people ignored the technicals. A lot of people ignored the history that I'm showing there. And I think it's just so important to kind of, yes, use technicals, but again, I use a little bit of the F word, fundamentals, but then just also looking at market past for some type of potential path for the future. So what do we see now? I'm almost done. I think I've got about 2 or 3 minutes here, so let's wrap things up. Love this Lou Holtz quote, life is 10% what happens to you, 90% how you respond to it. So how's the market responded, right? I just want to talk about the election. I mean, the response we saw from stocks after the election was unbelievable. And hey, listen, people listening to this probably don't really care why stocks went up, just that they did. But the truth of the matter is we're going to have a probably divided Congress. That means higher taxes, higher regulations off the table. Stock market went nuts. Stock market loved that. Huge rally in November. And look at the first one, upper left-hand corner there. These are kind of 4 charts I thought are pretty cool. Or 4 tables, charts, whatever you want to call it, that I've created. We had 4 consecutive one-day gains on the S&P 500 right after the election. All right, or right before and during and after the election, I should say. So right around the election. Last time we saw something like that, October 82. Last time I checked, October 82, not the worst time to be bullish. You can see some other times it happened, 70, 74. Hey, kind of one of those, it is what it is. Very small sample size. Our statistician teachers in grade school or high school would be furious with using a example of only 3. But listen, I'm not going to ignore it, all right? 12 months later, you see the returns there. What we saw around the election is a really, really strong signal. Bottom left, number of stocks in the S&P making new 20-day highs. That right after the election jumped over 70%. That's really rare to see that many stocks make a new monthly high. And sure enough, that once again, the 12-month returns, 6-month returns, more often than not, are pretty positive. Upper right-hand corner is the one that just happened. We just had 90% of all the stocks in the S&P 500 above their 200-day moving average. Okay, that's overbought, maybe, potentially, sure. 1 month later, 3 months later, maybe you can get a little pullback, but 6 to 12 months later, it's still pretty bullish in my opinion. 12 months later, I took the first time that took place, over 90% of stocks above the 200-day moving average. And a year later, you see it there, higher 10 out of 11 times on average, or 10 out of 11 times on average, up double digits a year later. And then the last one is a third quarter. Third quarter is usually pretty bearish, or quote unquote, the most bearish month of the, or bearish quarter of the year. Well, it wasn't this year. We gained, what do I have up there? 8.5%. And I found other times we have a huge quarterly gain in the third quarter, which is normally not that strong. Fourth quarter strong. And this is stuff we were talking about to our advisors with market technical still strong, advanced decline line still strong, participation out very strong in our opinion. And we were saying, things are likely going to be higher, maybe much higher in the fourth quarter. Yeah, it's an election. Yeah, the uncertainty's out there. Yes, October got really scary with that pullback after a 5-month rally, by the way. And stocks, by the way, after a 5-month rally, a year later are higher 25 out of 26 times. So the 5-month rally we just had is normally going to resolve higher. So anyway, so those are those are some 4 charts that I showed. I just want to show it one more time here. The idea of the 7-year itch, these big long-term bull markets for whatever reason around the 7th year have a bear market, significant pullback, really scary times, but continued gains can happen for potentially years. And we think, that very well could be the scenario we're having once again. So I want to thank everybody for listening to this for the past 15 minutes. Really honored to be here. Again, huge fan of StockCharts and a huge fan of what Dave and the team what everyone's trying to do over there. And I'll continue to try to help out wherever I can. So with that, everyone, thank you so much. Again, Ryan Detrick. So I'm signing off. Here's to a better 2021. Let's leave it at that. See everybody later. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.